Welcome to the Weekly Trend, a podcast for navigating the markets through the lens of technical analysis. The Weekly Trend podcast is provided for educational purposes only and does not constitute any professional advice. Listeners should not act upon the information or content without first seeking advice from a registered financial planner.
Welcome back to the Weekly Trend podcast. Today is Friday, September 20th, 2024. S&P 500 currently sitting at 5687. I'm David Zarling, and I'm here with someone who has a silo full of sarcasm, Ian McMillan. It's one of the best things that we got going for us is humor.
Yeah, a silo. I
felt like that was a large container.
I can store it till futures prices go up.
That's right. You harvest the sarcasm and then you just
sell it onto the market.
That's right. This here is the best sarcasm.
I take it into town for the auction process.
And then they're like, wait,
gather
is this really the price? Are you serious?
It's sarcasm. Sarcasm has gotten, there's not a lot of sarcasm that goes around anymore, and it's gotten pretty expensive.
Yeah, because the humor hurts. People don't like funny for whatever reason. I mean, in some states, they're trying to outlaw funny.
Isn't that
free? That's free speech, Ian.
They're going to outlaw our podcast. Gavin, though.
Yeah, he's going to try. Go ahead and come for it.
Well, on a brighter note, we got new all-time highs this week for the S&P and Dow.
Yeah, I heard that all-time highs don't happen in a bear market.
Woo! You hear that sirens? That's a sarcasm coming for you.
Well, and I think even so, yeah, S&P 500 new highs, Dow Jones. And then you look at equally weighted, right? Because we don't have to just look at gap weighted.
You just pointed this out.
So if you look at EQAL, which is the Russell 1000, so it's basically your S&P 500 and then the next 500, 1,000 stocks in the U.S. equally weighted, trying to close at brand new highs this week, right today. The market's gone too far too fast, right? I mean, that's 0% return over what? When was the last high there? 34 months, 0% return for 1,000 stocks.
And this is a true, right? And I like that you used Russell 1000 because I think it's a true right? We know the S&P is a cherry picked. I mean, yeah, they're large companies, but it's still...
It's a momentum product.
Yeah.
You know, the large, the big get bigger.
Your Russell 1000, your Russell 2000. I mean, it's straight up like, it is what it is. I think they switch. I think it's annually sometime in June or July. But hey, whatever your market cap is, come June 30th, if you're in the top 1,000, you're in the Russell 1000. And if you're not, then you're not. Pretty simple, being a pretty true representation. I think you even took it a step further with the equal weight.
Yeah.
I mean, it's a great representation, much more so. And of course, we're probably guilty of we are guilty of this. We talk about stocks, quote unquote. I said it right when we got on. Stocks hitting an all-time high. Well, the S&P did, the Dow did, but this equal weight Russell 1000 is even more of a pure example of, quote unquote, the stock market.
You completely agree.
Yeah, all-time highs this week.
Mm-hmm.
So how can you say, going back to your question, stocks have gone up a lot in recently, the last 10 months, but you zoom out and
there's room to run here. And that's maybe hard for some to believe. I mean, Russell 2000 hasn't even gotten to a new high. I mean, Russell 2000 is the same price level it was February of 2021.
Man,
I mean, that's a long time. Some people have had children who are now walking and potty training during that time.
And that thing hasn't done anything in that range. Hey, and we lived that range together.
We did.
And Kevin.
And I wouldn't want to live through it with anybody else. I mean, it's a legit period of time where markets correct. They
And it would be,
consolidate.
it would be normal. Okay. Say you pull up a chart of IWM, 210 to, we'll call it 233. I mean, it's realistic that we live in this range again for
Right. There's a lot of history here.
so much history.
Because we know by studying supply and demand that the range from February of 21 with the false breakout and then subsequent move down in January 2022, that was distribution, meaning at an institutional level, at a massive level, those stocks were being distributed, more supply than demand, and therefore we corrected. And then you could argue the opposite, the range that developed, the largest range we've seen since the 70s, 22 and 23 in small caps, that was accumulation. So you have this battle between buyers and sellers, which is otherwise known as equilibrium, that we're at this place again where we have the buyers have to prove themselves here. Same with EQAL, same with the Russell 1000, the Russell
You
2000.
got to keep going.
You have to be able to chew through a supply, and the buyers have to prove themselves. And what's interesting about some of these ranges that are developing is it does up the auction process, and it causes buyers and sellers to interact. It's a competition. It's who really is putting money where their mouth is. And, you look at IYT as well. I think IYT up against a price level that goes back, the 70 level in IYT representing transportation, and kind of had a reversal type candle this week. We'll see what they do with it next week. And so you have, I had the privilege of going on Stock Market TV last week. This is that, I know it's an overused term, but we're there in an inflection point.
Yeah.
Like either EQAL, or the Russell 1000 is moving higher and breaking to new highs, or it gets sold off here and we consolidate some more, or it really is the top of the market. But we won't know that till later. But man, go ahead.
Go ahead. Well,
I was just going to say, go ahead.
I think you make such a great point with, I don't think it's an overused term. We're just at a period in the market where a lot of things are coming into inflection. Like, that's what happens when you go sideways for 2 years.
Right.
You get a lot of inflection points. If this was 2013, 2017, probably not a lot of inflection points.
Right. And what Ian's highlighting there is a lot of inflection points. Oil, right? When we look at oil, it's at a horizontal price level where buyers have stepped up in the past. We don't know if they'll step up here now, but this, call it $65, $66 level, really important. That goes back to 2021 again. You look at the dollar, DXY, using a trade weighted dollar, this $100 level is an inflection point. You look at EQAL at an inflection point. You look at transportation stocks at an inflection point. This is where we need to pay attention.
Well, I think, we all love to joke about, we all want, probably not a joke. I don't think anyone disagrees with wanting, the quote unquote lower prices at the pump.
Oh, sure.
But oil's probably not something you want to see go to $20 a barrel.
Correct.
Like, we're kind of in this sweet spot. It's, we're $70 a barrel. This is where you can get some pretty good. It's stable. We haven't gone anywhere for almost 2 years on oil. We've been between 60 and maybe a couple spurts up into the high. But I think this is exactly like where you would want oil, to just chill out. You look at like some of the more recent rallies we've had in stocks, 2012 to 2013, 2017. Oil kind of just chilled out.
Right.
We didn't have big moves. We kind of just, the 90s, it was pretty, of course, there's probably more volatility in every single asset nowadays. So,
well, and what consumers need to remember is we tend to be very self-centered when we think about these things. And here's what I mean. Yes, it's nice to have lower prices at the pump for yourself, but there is a point, and I think this is what you were highlighting, is earth movers, semis,
construction,
airplanes,
Airplanes, yeah.
construction. They all use,
Back
these
to
are,
your, I mean, IYT, like you just mentioned in general,
right. These are all areas that consume liquid energy. And if there's not enough demand for that, that's
bingo.
a warning sign. So we'll see. I mean, and oil being heavily linked to gasoline, it is worth paying attention to that we hold the 65 level. You could see, and I'll say gasoline, if we're using futures for that, holding $2. And that should give everybody an idea of how much it costs to transport gasoline and what the taxes are in their own state. If I'm saying $2 a gallon and you pay X, well, that difference. So you're probably paying a third. I know in Wisconsin, you're paying a third in whatever it takes to get it to market and taxation. In other states, it's different.
Yeah. And of course, that depends on how close you are to some big pipeline.
Yep.
Uh,
And gasoline blends, right? In the upper Midwest,
Blends.
we shift to different blends based on winter, and we're about to hit that. We're coming into that period of time where we're going to shift blends. I don't know what it's like in North Carolina. I mean, you guys don't. I mean, you get some winter, but you guys are also below kind of the snow line, is what I'll call it. Because you guys don't. I mean, you might get a snowfall, maybe.
We get maybe every 3 to 4 years, you'll get something decent, but for the
You get
most part, it's going to be a dusting.
like a snowflake. You get a snowflake.
Yeah. Well, and so, okay, let's go back COVID. Let's take out -40. We had $20, like you can get $20 a barrel on crude. Does anyone want to go back to that? No. So I think that's a great example of your point. Like cheaper oil and energy sounds cool when you pull up to the pump in your SUV or your truck or whatever. In the grand scheme of, is the economy alive? You really don't want quote unquote cheap oil.
Right. No, a nice balance. And it's the beauty of supply and demand. It's the beauty of free markets. When you hear someone talk about fixing prices at like a grocery store or energy products, you should immediately get nervous, because that's what brings economies down. I mean, and we've done things like that in the past in this country. There's other notorious countries that have done things like that, like Venezuela, trying to put in price controls.
Yeah, tell me about Venezuela.
Yeah, not so great. Great baseball players, amazing baseball players. There are a few of them on the Brewers, division champs. But as far as like price controls on goods,
Great
not a
segue.
great idea. Yeah, I had to.
You have to.
I was fighting. I was like, how am I going to get this in there? Perfect. Venezuela. But yeah, I mean, you want free markets, because free markets are a weighing machine. They're a discounting mechanism. They let you know what's really going on. And that's why we use technical analysis. I mean, I love all the fundamental stories. I mean, I get it. I get why people get wrapped up in Jerome Powell talking and rate cuts and all those things. But as you've highlighted in the past, the bond market runs before what the Fed does. I mean, is it really all that surprising that TLT or treasuries, long duration treasuries, ran into prior resistance as the rate cuts were announced, and now we're cooling off there? So if you went and bought 30-year treasuries and don't have a process for how to diagnose whether they're confirming or denying a thesis, the only way to do that is with technical analysis.
It's the only way. And I've seen, as this run gets more extended, Dave, and to go back to your phrase earlier, we've gone too far too fast, which I think that really depends on how far you want to zoom out on charts.
Well, and what are we talking about? Are we talking about something like orange juice, or are we talking about stocks?
Yeah.
If we're talking about stocks using EQAL, we have a 0% return for 3 years. If you're talking about orange juice, I mean, I might be able to see your point.
Well, and there are now at this point, there are plenty baskets full of talking points about why the market shouldn't and cannot keep going.
Correct.
I mean, we're so deep in, if Kamala gets elected, or, it's just I mean, just whatever the cost of living. Yeah, to go to your point that we're up 30% in the last, what? I mean, when did we bottom? October 2022, technically, probably.
Yeah.
Like,
Well,
we're
even
up so much since then. And there's all this personal pain from people that probably overextended themselves. That's not the point. But there's a lot of hand reading out there about why it is absurd that stocks would go higher.
well, and
And
let's be frank. I mean, I see the receipts from the grocery store for my family.
yeah,
Prices have absolutely gone up, but
they have. And no one is going to deny that.
right. But let's remember why we're in markets. Like why, as an investor, as someone who's going to retire, we are involved in them to protect purchasing power. We are not involved in them because they're fun. You know, I get it. I get that there's a million subscription services out there. There's all this, fancy, you can trade this, that, and the other thing. And those are good and great. And you could treat it as a casino, or you could treat it as, this is how I protect my dollar.
Keep up.
This is how I keep up. Because in the end, when you retire, you're going to have funds that you need to access for your lifestyle, for medical expenses, you name it. The reason investors are involved with markets are not for the jollies. It's for being able to protect your dollar. And when you have inflationary environments, you do see equities move higher. You do see things like, we haven't even talked about gold yet. I mean, it's interesting how quiet the industry is on gold at this point, considering Gold Bug Nation is alive and well.
Gold Bug Nation is alive. I mean, and it looks good on an absolute basis. It's up another percent today.
But
I want to own gold over stocks?
Yeah, it's been in a range since February of 2022.
I'm just not there on that trade-off. You got to show me more. And I can make that decision. How long it takes me to make that decision, Dave? 2 seconds.
Yep. And the chart can show you that.
The chart, I pull up a chart, I divide gold by S&P, and it hasn't gone anywhere. You are at it's been an equal trade-off, like you said, for 2.5 years.
Yep. You could have owned gold, you could have owned stocks, but does that not speak to the reason why we're involved in these things is because it's about keeping up with the price of orange juice. It's about being up with the price of these different things that are in the market, right? Because when you retire, you don't stop eating.
And that's why the mattress savers don't. I know it's a noble mental thing. Probably not as common as it used to be in previous generations. But yeah, you can't just shove it in a mattress. You got to put it to work.
And we're starting to get to
risk. Does that take risk? It does. It does take risk.
Opportunity risk.
Yeah. Then there's also the opportunity risk of if you don't keep up. Right. If you decided you were going to put it in a CD, up until 2 years ago, paying you basically nothing. I mean, is it safe? Yeah. Is it going anywhere? No, it's FDIC insured. You're fine. You can collect your, historically speaking, very small amount of interest, or you could have had it in stocks. And, it's.
Well, do you remember peak T-bill? We call it peak T-bill internally, where we were getting a lot of inquiry about, should I just own T-bills and get that? And I'm not saying, so some of our models hold T-bills. We're not opposed to T-bills. They're, paying 4.5 to 5.5%.
It's still better than having it be in cash.
Right. But since late October 2023, you have equities up 38%. And at that time, having to walk clients through that there's opportunity risk here. Like you could either get 5%, and we're not even at a full year yet. We're about a month away.
Or you can get 28.
Yeah. So markets are a wonderful place. It is the lighthouse of capitalism and free markets. There, to be able to participate in all these different types of things, like to be able to buy something that's a K1 free gold product or to be able to buy Argentinian stocks. This wasn't something you could do 20, 30 years ago, but now we can. And we can identify using ratio analysis, relative strength analysis, where is the strength? And there's something to be said for what we're seeing out of financials or what we're seeing out of financials globally. Even if you look at EUFN, European.
EUFN is on. It's above. I'm pretty sure that was on it's above a relative to now close. But hey, look at this. Year-to-date highs. Really 6.5-year highs.
So there's definitely some undercurrents developing in financials and Argentinian stocks that using ARGT as an ETF as a proxy for that. There's a fair amount of financial Argentinian stocks in there. And time will tell how that all plays out. But if you have Singapore also performing well, you have to do your due diligence because you can't just buy VEU, right? VEU versus the S&P still in a massive downtrend that's been going on for well over a decade. But there are spots that are showing up internationally that you can participate in. Perfectly viable. So what else, Ian, worth highlighting? We could shift to bonds.
Let's do it. Bonds, let's do it. I think that's a great segue, right? So we had a 50 basis point rate cut this week. So that would mean, right, Dave, that, clearly rates will go lower. They just cut them. So bonds will go up, rates will go lower. We know how the machine works, yada, yada, right?
Really what we're seeing.
Or is it just the fact that, like Dave and I have talked about for literally years on this podcast, bond market already made its move.
Yeah, it's priced it. And this is the hard part for a lot of investors, because if you consume popular financial networks or popular financial magazines, somehow we think we're getting inside information and we forget that the market is an arena full of really smart people whose very livelihood depends on this. And so they're looking at this information, digesting it, putting it in their pivot tables, putting it in their Excel sheets, figuring out all these different factors and looking out 6 to 18 months. And the market was basically continuing to highlight that this rate cut was not a surprise.
Well, and it goes back. It's cool and fun to talk about the S&P and individual stocks, but the amount of money moved around in the fixed income arena just absolutely dwarfs anything to do with global equities.
For sure.
Absolutely dwarfs it. And these are, there are entire governmental, $1 trillion budgets run off of what treasuries or U.S. treasuries are going to do, because that's how they're funding it. And these governments need to be aware of what is going on I don't care what Apple's doing, but U.S. treasuries make a move. Oh yeah, that's a big thing.
Well, and even the credit markets, when we look at across the spectrum. So if we look at like credit markets for, municipal communities, or you look at credit markets for Apple itself, or you look at credit spreads, you look at triple C credit, we had a spike in a tightening. And so the way you look at triple C credit is these are funding for really either highly levered or poorly run companies. And so they're paying a higher interest rate. And what we're seeing is actually, since the VIX spike, a massive cooling off in credit spreads, which is a positive development. That's a risk on type environment. Is if poorly run companies can get access to cash or the cost of that cash cheaper, that's a positive development.
Yep. And you mentioned this spike, Dave, right into August 5th, Monday, August 5th. We know what Monday, August 5th was. We got the big Sunday night Japanese yen I think they raised rates, right? By like 25 bips. Everyone got spooked in the currency markets, and big hoopla that Monday. I remember it like it was only 6 weeks ago. And since then, yields have crashed, yield spreads have crashed, and the S&P is up 13%.
And it was a wonderful time to analyze. So when volatility increases, what's important to remember as an investor is that's when correlations go to 1, meaning most investment instruments start trading the same direction. And the beautiful thing, oh, sorry, go ahead.
I was going to say, everyone, you just sell it, you just went out.
Yeah. And the beautiful thing is that's the very environment to understand what beach balls got pushed underwater and that are going to pop back quickly. I think about housing or home construction.
For sure.
As an example of that.
I would say that's got to be just on the, I forget who has I think Dan has consumer discretionary now workbook.
Yep.
But yeah, housing came back very quickly, had been a leader. And after all the dust is settled, it remains a leader.
Right. And that is an important concept that you just brought up is what has led us since October of 22, the bottoming of the market, which you don't know in real time. But as we moved out of that, what were the leaders, right? You had Eli Lilly, you had NVIDIA, you had housing. So when these VIX spikes happen, when these volatility spikes happen, do those things continue to hold up, or are there divergences that are breaking down? We have not seen that. We've not seen the things that have been leading, like semiconductors, NVIDIA, Eli Lilly, and there's quite a few other stocks that have led since then. So I don't want to just limit it to that, but just the simple point being made that the leaders continue to lead, and that's a healthy piece of information to keep track of on whether this market is over or not. And so we continue to see a bull market confirmed. Now it really gets confirmed if we see transportation stocks, Russell 1000 equal weight, hold these highs.
Semis come back.
Right.
Semis are back. I had a good week. That's been one of your leaders. And we got a trend line bounce. We got the 200-day bounce. There was a good risk reward here on semis lately, not back to new relative highs yet. And I'll be honest with you, and we put this out in January. We broke above when we broke above 4,800. A fib extension of the the 2022 bear market, a fib extension, 4,800 down to about 3,500. That was going to take you to 5,600 on the S&P. Put that out there in January when we broke to new highs. A lot of angst over that on my Twitter. So we got to 5,600, actually a little bit quicker than I thought we would. And we consolidated here for about 3 months. So again, I just want to put it out as a warning that should we hold above 5,600, feels weird saying this is a warning, but since most of the market mentality is, oh my gosh, how can this keep going? We hold 5,600 and there's our next target is essentially 7,000. It's another 25%. So 5,600 to 7,000 is 25%. Is that going to go in a straight line? The answer is I'm 99% sure it will not go in a straight line.
But it's interesting that that's setting up going into the
target,
the best 6 months.
Yeah.
So there's the best 6 months, November through April is historically, you look at any cycle, November through April of the following year is the best 6 months. And especially so in an election, post-election, whoever your candidate is. I don't
Whoever your candidate is, I don't really care. I'm genuinely just trying to retire.
Right.
And I will say this. So we talk about, okay, Ian, well, what is your time frame? If we stayed on trend, we stay on trend, the Halloween 2023 lows, we get to 7,000 in the S&P basically in a year, basically by next. Now, can it go before then? Right? I mean, we reached 5,600 in July. We're still kind of there, right? You get the consolidation. I mean, it is very much not unlikely. We are at 7,000 by next on the S&P. And
And the
I
beauty,
am not willing. I think the big mantra that if you've listened to this podcast for any amount of time, I'm not willing to just put my retirement on hold because I quote unquote don't think that could happen, or I think that that's crazy. I'm not willing to do dude, we're above 5,600. I'm in more than a handful.
right.
We're
Well, that's,
below for
yeah.
sure. It's coming off the table.
And that's the beauty of technical analysis is Ian is highlighting the potential, but not going in blind and saying, I'm married to this opinion. It has to be my way or the highway. He's saying, if this, then that. It's a binary outcome. The potential is there, right? We have a bullish percent that's sitting, the offense has the ball, but it's not at the goal line. It's at like the opposite 30. So there's room to run your plays. There's room for upside, but we can be wrong. And 5,600 at this point is that level. You would know that you're wrong. And then you start talking about the 200-day moving average is the next level of these different instruments. So Ian's talking about making a call, but contrary to how they do it on Talking Head TV, there's an opposite approach. Ian married his wife. He didn't marry his opinions. 7,000 can be a thing.
I mean, we fall back to 5,600. I think I'm done. It's off the table. Clients know that's there. It's on the table.
It's a thesis, right? We're Bayesian scientists. You take the most recent information, you give it a heavier weighting than prior information also being important. For example, if you use XLK versus S&P, so technology versus S&P, well, we do have a horizontal level that's important to note on whether technology is worth being involved in. That goes back to March of 2000. We haven't cleared that level, but what's interesting is you are seeing other areas of the market starting to step up. And do we see a broadening out of participation as we head into November?
Yeah, I mean, you've got tech below a relative 200-day that is now flattening out.
Which we know a flat 200-day typically means a hot mess.
Mess. And yeah, I'm here to tell you, and maybe this changes. Maybe we're here in mid-October and I have different feelings, but not, on the S&P and be in the same boat. You're not missing out. There's no opportunity cost right now in tech to me.
Right. Right. You're just saying that relationship's at equilibrium. At this point, you might not be able to gain an advantage there over if you're saying the default is being involved in the S&P, that technology might not provide that at this point. Time will tell.
You got financials. You just mentioned financials and the move they're making. Real estate holding up. I mean, discretionary to its highest relative level since May today. Industrial's trying. They got a flat relative 200-day. I think, golly, that's a perfect example of a hot mess relative chart.
Are you using XLI for that?
I am.
Well, in some ways that has a rising, and it does have a rising 200-day and just came out of consolidation. Yeah. So economically sensitive areas continue to lead. This isn't a scenario at this point that it's, hey, we're hiding in staples, we're hiding in the yen, we're hiding in risk off areas. And there are stages to market development. There are times where it's just stocks performing. There's times where it's stocks and bonds. There's times where it's stocks, bonds, and commodities. And it is interesting to see gold doing what it's doing. Meanwhile, not all commodities are doing that. You have oil against it, as we highlighted before, against the reported level. But the overall weight of evidence, again, weight of evidence in a courtroom, continues to support that this market is guilty of an uptrend. It just is. And that can change, but the evidence has to present itself, and it hasn't yet.
No, and
Someday
I
it
think
will.
you still
Someday it will.
see, the ETF continues to stay out what I would consider on the risk spectrum, in regards to what it's like. We don't need, that's all public information. But yeah, it's, not every day we're going to be up 1%, but hey, you said this 30 minutes ago, higher highs and higher lows. I don't know what else to do. I don't know what else to tell you.
For sure.
It's an uptrend. It's an uptrend. And we just broke again new highs on multiple indices. And advanced decline, like breadth has been okay. All the advanced decline lines are fine.
Correct. And
Dow,
this is
NASDAQ, S&P, NYSE composite. All those advanced decline lines continue to move higher.
And, what's interesting is investors also tend to get myopic about, interest rate cuts at the top of a market. Well, if we only look back to the year 2000, yes, I get it. Like Shane Murphy, a technician I have a lot of respect for, he did the research, he did the work. He didn't just get myopic and look at 20 years of data. He looked back in time. And when we look at the first rate cut, so this being the first rate cut, being above 25 basis points, we had a 50 basis point rate cut. People tend to be like, recession is here. Here comes the recession. Well, yeah, if you look back to the year 2000, that's an accurate statement. But when you look beyond that and go back into the 80s, that's very untrue. You see 12-month returns that are double digits. So do we really get to be surprised if there's a rate cut and the market continues to run? I don't think so, because markets move in different cycles. We can't just look at the cherry picked data that we want to look at. His chart is pretty clear. Yes, 2001 and 2007, we had a rate cut and there were recessions. The first rate cut, there were recessions after that, and you had negative S&P 500 returns. But when you look back to the 80s and 90s, you had positive 3, 6, and 12-month returns. And so credit to Shane for looking this up and actually doing the work rather than just buying into the narrative that others are trying to preach out there that is only looking back a certain amount of time. So is this the top of the market? I have no idea. We won't know that till later, but we will know that below 5,600, that below 5,400, below a 200-day, that's more likely that thesis increases. But at this point,
4,800, below 4,800, we're probably screwed. But hey, that's also a big rate. There's also, you can have a 15% drawdown, would be so painful and so loud, Dave. Oh my gosh. And that just takes us back to 4,800. Can you imagine a 15%? So loud, so much adamancy about this is it. This is where it ends. Think about last October.
And so it goes back to, how do you make investment decisions? We know we need to be involved with markets to protect purchasing power. How do we then engage the market with a rules-based approach? And the very simple answer is by using technical analysis, which is the study of supply and demand being economic law, not economic theory, not voodoo, not some made up contrived thing, or not some data point that gets revised later. You're using the hard data, the most recent data you can get to make educated decisions, understanding that pride is set aside and you participate until the data says otherwise. And right now the data says to participate, as we have been since Reformation or late October 2023. Our clients are very familiar. We've been very heavily involved in this market, and there will be a day that changes. There will be a day that we have to adapt. And speaking of adapting, I should highlight the supporter of this podcast, the Adaptive Select ETF, listed on the NYSE under ticker ADPV, which helps investors access two of the most prevalent factors in markets, momentum and relative strength. Using proprietary identification methods, the Adaptive Select ETF attempts to own the strongest 25 large cap stocks when the market is in an uptrend. And since not all market environments are the same, Adaptive Select seeks to prevent extended declines by moving to short-term treasury bills and cash during long-term market downtrends. Investors can find out more, including how to invest in ADPV, by visiting adpvetf.com or calling 1-833-880-5200. As always, investing involves risk, including possible loss of principal. ADPV is distributed by Quasar Distributors, LLC. Ian, what else do we want to touch base on? We haven't talked crypto. We could cover more commodities. We could highlight other interesting area developments. Market-wise, where do you want to take this thing before we wrap it up?
I think Bitcoin continues. It's still below a 200, right into the 200-day, last couple sessions from the underside. But really, I mean, you zoom out on a Bitcoin chart, and if someone made me place a trade today, it's probably a buy order. The consolidation, the wraparound here around this 65,000, 64,000 that we've seen since February. So we're 6-7 months into, it's high, like Bitcoin is what it is. High beta, has big daily moves. But from a price behavior standpoint, that's quite the, I guess if you like names for chart patterns, quite the handle on the cup and handle.
Yeah, it's a quality digestion of supply. So if we're saying supply exists at 6,300 or 63,000, 64,000, we know that to be the case because that's where Bitcoin sold off in April 21. That's where Bitcoin sold off in November of 21. We've since gotten back to that level and moved sideways in a range that Ian's talking about, potentially chewing through supply. If that thesis is correct, we would see Bitcoin clear 70,000, and we would be more than willing to participate in that if it is not an opportunity cost. For example, if we compare it to the S&P 500, if we look at Bitcoin versus S&P 500, that's where you want to see this 15 level. So if you take that ratio, 14, 15, you want to see clear that in order to say, yeah, I'd rather put the dollar to work for my client in Bitcoin than in the S&P. We're not there yet. There may be a day. We're just not there.
But I think, like I said, and this is a wide range. Bitcoin is high beta.
It's a bucking bronco.
This is a 33% range. And you can say, oh my gosh, Ian, that sounds insane. I can't deal with a 33% 9-month range. Okay. Take off the axis, take off price. It's a 33% range coming off of what was, 370% move. So this is a very tight consolidation in the context of Bitcoin. I think it's healthy. I think it's if you're below a 200-day, I can't give you the go ahead. That's just kind of like a personal.
Yeah,
we got at least be above a 200-day.
Yeah, you want to see the prior 200 days of information show that buyers have control.
But it's there. I'm not shocked if by January we are above 70,000.
Right.
I'm also not shocked if by January we're sitting at 63,000, exactly where it is today.
Well, and give an insider's view on how technicians work. The thesis of higher exists above 55,000. And if we're below 50, above 55,000, that thesis is intact. Below, that thesis is broken. And so again, that's that binary decision making. If this, then that. It's like being an option quarterback, or it's like picking on that linebacker where Wherever the linebacker goes, you go the other way. Same thing with Bitcoin above 55,000. This consolidation, and it's information, right? Quote unquote, should resolve in the direction of the prior trend being up. So this consolidation in Bitcoin should, quote unquote, resolve to the upside. When it doesn't, that's information. You sit up and go, oh, this all turned out to be distribution at this level. And so you wait for resolution out of this. So we'll see. Time will tell. It's another range. It's another inflection point that exists at a horizontal level. And we're seeing this across a wide variety of instruments, and probably something that exists until the election happens, regardless of who your favorite candidate is.
Would agree with that.
All right. We are up against the end of our time. Anything else you'd like to highlight before we jump out of here?
Continue. It's an uptrend.
It is. And we're involved.
As you wish.
Yeah. Involved because this is how we keep up. This is how we protect purchasing power. If an uptrend is on our hands, we have to participate. We don't have to participate below 5,600, or we could take our foot off the gas below a 200-day moving average. We don't have to participate. But right now, the opportunity cost at this point is not being involved in this market. We continue to see higher highs and higher lows, rising 200-day moving averages, quality breadth metrics. If you want to check off boxes, these are it. Does it have to continue? It doesn't. I wish I knew the future. We don't. But Ian, I love doing these with you. We hope our listeners really appreciate this. If you do, we ask you to share it. We ask you to give us a high ranking. That gives us feedback that you appreciate what we're providing to you guys. With that, Ian, thanks for being on here again with me.
Have a great weekend, everyone.